Good evening, everybody, and welcome to the 10th edition of a Quarterly Connect webinar. Thank you for taking the time to attend this evening. We'd like to thank all our investors for trusting us to manage your wealth and all our distribution partners for the support extended to us over the last several years. This evening, Prashant Khemka, founder, will start the session with an update on the portfolio and performance and address some common questions which our clients often ask us. At the end, we will have a Q&A session. I'll request all of you to kindly post your questions in the chat box. I'll now invite Prashant to start with the portfolio update. Over to you, Prashant.
So let's get rolling quickly with the performance slides, and then I'll invite, beyond performance, I'll discuss a couple of questions that we've been receiving quite regularly from investors, despite what I believe, we've sought to answer that over the years, but we've put in more effort this time to try and explain ourselves better. This relates to the number of names and the portfolio turnover and whatnot. So performance, obviously last year was a challenging year. This year is more, I would say, so far stable. Obviously, first quarter was negative 50 basis points, though we've had a good, or as of date, it has turned positive in the second quarter, but call it flattish year to date. Either ways, better than the negative, but we are very much hopeful of going back to our old average, if not exceed that, as a longer term average has been very strong. Over the last, because of obviously the challenging last year, since inception numbers are now more muted, 15.9% CAGR, still very strong, as you'll see later on in peer group comparison. It puts us at the top of the peer group, at least top of the peer group as measured in the largest dozen PMSAIFs out there. So 97% cumulative return over the last coming up to 5 years now, net of fees, compared to 75% of the benchmark for 2,140 basis points, or 21.4% outperformance. As I noted below, earlier, most of the alpha always has come from stock selection, whether viewed from market cap or sector allocation basis, and it's positive across, as you'll see, most sectors and most market caps. These are the top 10 names by contributors and detractors over the last close to 5 years. You'll see a very good distribution. So this distribution is far superior. Now you may say, or one may say, that doesn't matter how the performance has come, whether it's come from 1 stock or 5 stocks or 100 stocks. But globally, investors, institutional investors, would feel a lot more confident when performance comes in a more granular fashion like this, because that shows law of large numbers is well at work, and hence potentially the performance has come from skill rather than luck. If it comes from luck, then the likelihood of repeating it may be lower. To give you a very extreme example, and this relates to the number of names question that we are going to deal with shortly. Yeah? If, let's say, there were 500 monkeys who were picking stocks 5 years ago, and they were all asked to pick 1 stock each, someone would have picked, say, Bajaj Finance, which is over here. We also did pick, it was one of our stocks, which currently is at 1%. One of the monkeys would have picked Naveen Fluorine, if it was a single stock portfolio that they were allowed to have. All of them had one stock in the portfolio. Yeah, 500 monkeys, and they picked them randomly. Yeah? Fast forward 5 years, one of the monkeys would have 500% return. Maybe there are other stocks in the 500, one of the monkeys would have 2,000% return and all. And if you don't do the analysis, and if you just look at the return number, yeah, the monkey with the highest return would appear to have the highest performance and appear to be the best fund manager, whereas they were all just throwing darts on the dartboard. However, it is highly unlikely that if you have 500 monkeys pick 100 stock portfolios each at random, that there would be any monkey who would materially outperform the average or other monkeys. Highly unlikely. The larger the number of names, the more unlikely it is that any one monkey would. So when I say the larger the number of names, what I mean is, if the game is, instead of picking one stock each, if the game is to pick 100 stocks, each monkey has to pick 100 stocks. Yeah. It's highly unlikely that any one monkey, because then none of them have any skill, it's random. It's highly unlikely that any of the monkey would outperform to a material degree. Yeah. Only if there is skill, then in a 100 name portfolio would one outperform. Whereas in a one name portfolio, even without any skill, you can outperform. But that outperformance says nothing about future potential to outperform. Yeah. So I gave you a very extreme example of one stock versus 100 stock. What if there is a 2-stock portfolio? The luck factor may be somewhat less than a 1-stock portfolio, but still the luck factor is huge, because there would be a monkey who would pick up Naveen and maybe Bajaj, or Naveen and Coforge, and get lucky. What if there's a 3-name portfolio? What if there's a 4-name portfolio? 5, 10, 15, 20. The luck factor keeps receding as the number of names increase. As the number of names increase, the skill factor increases. Yeah. And if the skill factor increases, skill can be more relied upon to perform going forward as well. It's like, while there's still the role of luck is always, you cannot rule out, even with a 100 name portfolio or higher name portfolio. But it's like, if you playing bridge is an example that I often give. If you play bridge in any 1 or 2 or 3 games, even the best team can lose, and a very mediocre team of bridge players or a weak team of bridge players in any 1 or 2 or 3 games may win against the best team in the world, depending on what cards are dealt. So just in 2 or 3 games of bridge, you cannot decide which team is better. And then and it can be very skewed by luck. But if there are 20, 30, 40, 50, 60 games played, high number of games played, the larger the number of games played, the more likely that those who are skilled would be winning the series or the tournament, rather than those with just luck. And that is why investors globally, institutional investors, would like to see a granular performance distribution like this. If this distribution was like one stock delivering 50 or 5,000 basis points of alpha, another stock delivering 1,000 basis points alpha, and then, very tiny, that may be just out of luck. That may not be repeatable. So that's a very important point. When we discuss, performance, sorry, the number of names question that we have, received, and not just here at White Oak, I received that question for last 17 years of managing India money professionally. Yeah. So very good distribution, both on contributors and detractors as well. The detractors are also small. That's also useful to note, so that no single company can blow up our performance. The risk management and position sizing has been well at play. The largest detractor is smaller than the 9th largest contributor. Yeah. So position sizing and risk management is well at work.
So just, this is year to date. This is because this attribution analysis, this is gross of fees, so shows a small positive, which earlier was a small negative because of the fees. But, basically, as I was saying, flattish year to date. Same thing here. These are the top 10 contributors and detractors year to date. As you may recollect last year we did buy Ambuja Cement, which hedged partly the Adani risk, if you will. Obviously, when you hedge a risk, it helps you when the risk that you are hedging goes up. Yeah. But it hurts you when the risk that you are hedging comes down. So it helped last year. Ambuja Cement was one of the top contributors last year, and this year was one of the top detractors. Amongst the outperformers, obviously a long list. I'm not going to go through each one of those, but you can see very good distribution again, year-to-date basis. This is what the portfolio looks like, and I'll talk a little bit more about it later as well when we talk about some of the portfolio actions following the number of names discussion. Continue to struggle to find investable opportunities in energy and utilities. Otherwise, overall absolute basis, a lot of investment in private sector financials, though market also, the benchmark also is fairly high. We have added considerable number of names, which I'll talk about later, in the industrials segment, and it helps mitigate some of the risk of underweight in utilities and government-owned companies and so on. In terms of large, mid, small, consistent with the past, mid and small put together are about high 30s weight, and 60% is in large cap. That hasn't changed much. The portfolio remains a far superior portfolio in terms of return on equity, in terms of OPCO multiple, which is our excess ROIC multiple. At this time, it is below the benchmark. P multiple, which we don't look at, but we put here because everyone likes to look at that. At an aggregate level, it is in line for a portfolio that has much stronger growth profile, top line as well as earnings profile compared to the benchmark. 67 is the number of names in the portfolio, which I'll come to later. As I said, there are several questions on that, somewhat higher compared to the peer group. This is peer group performance comparison. So what we have is for the first year, we have our AIF and other strategies performance of the team, because PMS launched sometime late 2018. If you compile for 5 years, then the performance of White Oak team is at the top of the peer group. Here, the peer group is PMS schemes that are over 2,000 crores in size and are flexi cap or multi cap or all cap, as we say. So not small caps, not mid caps, but flexi cap or multi cap, and are over 2,000. So obviously there's a bit of a selection bias, because over the last 5-7 years, only those would have grown to 2,000 plus, like ourselves, whose performance has been strong. But even amongst those strong group of peers, the team has over a 5-year basis generated the highest return compounded, and even over a 3-year basis, it's a fairly robust 9.2%. Last year was the only year, as you can see here, which was a challenging year over this time frame. But even last year, if you were to see compared to the peer group, we were above average. Not that we are happy about it, but good to see. We are the only one in the entire group of this close to a dozen or 11-member team who is every single year above average. In year like 2017, for part of the year, we would have been second best. 2018, which was a very difficult year for all managers, because anything with poor governance got taken to the cleaners. And it really reflected our strong performance that year, despite a terrible year for small and mid caps, because of overall strong governance quality of our portfolio. We did better than all other managers in this cohort. 2019, you can see where it is. 2020, again, we were best performing. There's no other manager who's best performing on 2 out of these 5 years, and no other manager who's above average in every single year. The consequence, since inception, we are not only the most consistent performer despite last year, but also the highest performing. Interesting to note that over a 3-year time period, while we are fourth, I don't know which portfolio this is, but the portfolio that is the best performing over a 3-year time frame is actually the worst performing over a 5-year time frame. So that portfolio, whichever it is a highly volatile portfolio, ranking sometimes towards the high end, but then ranking interesting in 2018 would be and 2019, which were 2 years when poor governance got punished. This portfolio is towards the bottom. So I don't know again the name, but I think we should leave that aside. In any case, the discussion is more about us. So point is, as is captured in this slide as well, where the blue row is obviously ourselves, and those fund managers or portfolios that outperformed our portfolio are above us, and those who underperformed are below on the various time frames. And you can see clearly the balance is in our favor, where the team has consistently outperformed the peer group to the strong degree that we discussed earlier. Now, those were by calendar year. Here we've also shown trailing 1 year, 3 year, 5 year basis, and since inception. Again, obviously the number since inception won't change, and this is what the trailing 1 year, 3 year, 5 year looks. As you can see, on a 5-year basis, we are the second best in this case. Again, the top performer is the one who is at the bottom by a 3-year basis in this case. So and on a 1-year basis is top performer, so highly volatile. We are the only one, or we are one of the few, possibly might be the only one, who's in the top or above average in each of these time periods, and since inception at the top. This is just the different frame to look at. I'm going to take a quick pause here from the India strategy and cover performance of our emerging markets strategy, which several of you or many of you have invested and continue to express strong interest in, and are at different stages of the paperwork. But what this is the GEM-X India strategy, which we launched at the end of December. So it's just I think this is, as of April. So this is just 4 months of performance, not a long performance, but that's all we have. So that's what we are sharing. The GEM performance, because we had initially launched the overall GEM fund, which includes India, in June, but several of you had the view that because you already have so much exposure to India, it would be ideal for you to have a GEM fund which does not include India, because in our GEM fund, we have about 18% or so in India. So we launched in December GEM excluding India, and happy to say the team's off to a very good start with the year-to-date performance of 7.61 compared to 3.66. The obviously inception date was on December 21st. Compared to that, for that also 6% return compared to 4.37, 159 of alpha. Bench BSE 500 during this time has delivered is down 0.5%. So not an appropriate benchmark, but just this highlights the benefit of diversification. It could be that some time periods GEM-X India does very well. Other times the India market does very well. So this is in a rupee term. Sorry, that was in dollar terms. This is in rupee terms. So satisfactory start here. The next slide is showing the GEM fund also, which several of you are invested in. One fact I'd love to share is in April, which is just a couple of weeks ago, White Oak launched our GEM closed-ended fund, which is called Trust in UK. So it's listed on the premium segment or the main market on London Stock Exchange. It was the first successful equity IPO after nearly 5 years. The last successful IPO was in 2018, and over the last 18 months, there were no other non-equity IPOs either that were successful. So great, in that sense, a remarkable achievement for someone from India, a team from India, to have garnered that kind of confidence from the UK clients, UK investors, and been able to successfully launch the IPO. So the performance of the GEM strategy, this is the UCITS fund. So just not to confuse, but this is the open-ended Dublin domicile fund, which several of you on the call today are invested in. The performance, and might be familiar with this performance, but just to summarize, that has delivered 6.86% return compared to -3 for 982 basis points of alpha dollar terms. Obviously, Indian markets also done very well over this time period. In rupee terms, 10.67 compared to 0.5 for the benchmark, more than 10% alpha delivered by the team over the last 10 months. Just to quickly, again, here also all of the alpha has come from stock selection by market cap, positive across each market cap. By country, again, if you, or yeah, this is by country, almost all 9.3 out of 10.1 alpha has come from stock selection. By industry, again, 11.3 out of 10.1 has come from stock selection. So it's great to see it's not coming from allocation effect, because allocation effect is very much deemed to be a byproduct of luck rather than skill. And again, top 10 contributors and detractors very well distributed. No single name makes or breaks performance. The top detractor is only as large as the sixth detractor. Obviously, it's a short time period, but good to see that, again, risk management and position sizing has been well at work on the downside, and law of large numbers well at work across board. Obviously, we also invest in companies like LVMH and Hermes, which many of you might be familiar with, make the very famous fashion goods and handbags. These companies derive majority of their business, nearly 3/4 of the value, from emerging markets like China, Korea, and others. So they are more EM companies in that their value is coming from EM, and hence investable in our fund. And they've done very well, as the business has done extremely well during this time. So I'm going to stop on this deck here and talk about, now move to discussing a couple of questions that we have gotten numerous times over the last 5 years, but even over the last 16, 17 years, and particularly more so over the last few months. Okay, so the myth about concentrated portfolios is maybe the title. We'll have to think about even fancier title, but we've been asked a lot about the number of names in the portfolio. Why do we have such a large number of names in the portfolio? Is that the reason why we didn't perform last year? Because a large number of names in the portfolio. So I want to address this question, hopefully once and for all, and put this to rest. And we'll happy to answer the question still afterwards also if you have, but hopefully this should address the questions that has pestered us for long. So remember, and I'll go somewhat line by line. Yeah, the goal, I hope we can all agree that the goal of investing is to generate the highest returns or outperformance. Yeah. Now, the next, at least this much we can all agree. The next line is what we believe, and we'll try to make the point explain this. Larger number of names provides greater flexibility to generate alpha, has been my consistent view that many of you would have heard before. Risk reduction is an accompanying consequence. It is not the goal. It's a positive byproduct, and it's a benefit. It's not the starting point of the reason why we own larger number of names, but it is a benefit that we also enjoy. Okay, but the key reason to have larger number of names is because it provides greater flexibility to generate higher alpha. Next point, small and mid caps, or SMIDs, have the highest alpha opportunity in any market globally. They are more volatile, no doubt, and greater risk, but and it is not to suggest that small or mid caps outperform large caps. There is no logic, no proof that, no evidence to prove that small or mid caps would outperform large caps. It's just that there are more inefficient segments of the market. So a good, strong investment team who does it correctly can generate higher alpha potentially in small and mid, as we have done, compared to large. There is alpha in across all segments, but larger alpha for a well-performing team in small and mid. A poorly performing team can destroy a lot more alpha in small and mid because the efficiency of the large cap is not there to bail them out. And there are routinely, as you all might be very familiar with, in Indian PMS world or PMS arena, there are many small cap managers who come and go, disappear after destroying tremendous amount of wealth for clients because the large cap efficiency doesn't bail them out. They don't know what they're doing in small and mid caps. They lose a ton. They make a ton of money in years like 2014, 15, 16, 17. But come a year like 2018, they wiped out. They wipe out client money and get wiped out themselves. So SMID caps has large alpha potential for good, well-resourced teams, but can be very treacherous for poor teams. Obviously, we believe we are a good team, and hence we do invest and capitalize on a successful, strong, long track record of successfully capitalizing on alpha and SMID caps. So portfolio with larger number of names can potentially harness higher alpha from SMIDs than the so-called concentrated or focused portfolios, okay? And I'll elaborate more and give some examples as well. India, particularly, by the way, has a large number of SMID opportunities. We manage emerging market funds as well. I have personally in my life managed developed world money as well. Indian market is in a way blessed, and that's one of the reasons we love to invest in India. It's a large number of SMID caps. Yeah? It is suboptimal for a manager, in our view, to handcuff herself or himself to only large caps or larger mid caps, which invariably becomes the case with concentrated portfolios with any material AUM. Unless you are running 50 crores, 100 crores, or 500 crores or so, you know, any material AUM, if you run a concentrated portfolio, which you would have a material AUM if you perform well, and you would have to invest either only in larger mid caps if you have a concentrated portfolio, or not have the constraint of concentrated portfolio like we do. So it becomes a handcuff really if you lock yourself into a concentrated portfolio. By the way, not everyone is equipped to invest in large number of SMID caps. It's not just as easy as someone deciding, okay, this is what, if you understand what all I said, okay, we will invest in large number of names. It's not everybody's cup of tea. It is a luxury to be able to invest, and we can afford that luxury by virtue of our very well-resourced team of high caliber investors. We have, overall a 40-member investment team, of which 2/3 or more, 29 members are involved in research in India. Yeah. For smaller teams, maybe it makes sense to have fewer names in the portfolio, and that may be more optimal given the resource constraints, because there are 500 to 800 names in small and mid. You cannot look for so many opportunities if you don't have a strong team, a well-resourced team. And to research one small cap name takes a lot more effort and time than that required for a large cap name. As an example, HDFC Bank, there are 1,000 analysts out there who put out reports on HDFC Bank. Yeah. So to research HDFC Bank requires a different kind of caliber and time than to research, let's say, I'll take a name of a very respectable name, IIFL Finance. It's a very respectable non-banking financial company, but it's a small to mid cap. It's on the verge of getting to mid cap. Yeah, there's hardly any coverage. Our team owns it, but the amount of work the team has done, primary research the team has done, is a lot larger than what has to be done at HDFC Bank. Yeah, so you need very well-resourced team of high caliber to successfully invest in small and mid. Otherwise, in a year like 2018, you get wiped out. And the reason why, despite owning majority of the portfolio at that time in small and mid cap, we were at the top of the peer group. And years like 2018 really demonstrate what I'm talking about here, which is that it is a luxury very few like us can afford because of our very well-resourced team of high caliber investors. If not for this, we also would have suffered heavily in 2018 and would not be on the top of the peer group. But if you don't have that, you are better off investing in just the larger and the larger mid caps, and you're better off having fewer names in your portfolio because you don't have the resources to cover large number of names thoroughly. If you have the resources, it's much better to have larger number of names, including the small and mid cap. But if you don't have the resources, you're better off smaller because that's the second best alternative, if you will. So all else equal, concentrated portfolios have a reduced investable universe, which is suboptimal compared to the much larger universe of companies that we are able to select from. In almost any business, a subset of a larger set would be suboptimal. So because of our resources and the openness and the idea to maximize alpha, for which you have to capitalize on small and mid cap opportunities, we have a more optimal universe or superior set of companies to choose from than those who lock themselves into a concentrated or focused kind of handcuff. So to summarize, and I'm going to talk more with examples as well, this is more a summary sheet. To summarize, the goal is to generate highest alpha for clients over reasonable time frames. At some other time, in maybe the next session or the session after that, we'll talk about what is a reasonable time frame, because we get a lot of questions on that as well. And it's not a very straightforward answer for even the smartest of investors or fund managers, in my view. We'll give our view on that another time. But the goal remains to generate highest alpha for clients over reasonable time frames. Metrics such as number of holdings or turnover are mere byproducts of the investment approach. Of anybody's investment approach, it should be byproduct. They are neither the means to achieve the goal, number of names or churn or any such thing. They are not the means by which you can achieve high performance, nor are they the goal in themselves. Many people in the industry make it out to be the goal. We run concentrated low churn portfolio. That's not the goal. The goal is to generate high alpha. Concentrated low churn portfolio doesn't necessarily mean high alpha. Is there any evidence globally to support that view? Hard numbers, not hearsay. So let me give you some evidence, at least in our case. And I'm not saying that concentrated may not be able to generate alpha. I'm just saying with large number of names also, top-notch alpha can be generated. We have 16 years of evidence of doing so, including the last 5 years at White Oak and my prior 10 years at my prior firm. And I'll also cite some other famous global fund managers because you might believe them more than you do believe me, and for good reason. But I'll come to that in a minute. So this is the portfolio performance over the last 5 years. Top performers, as you saw in the earlier slide, several of the names: Coforge, Naveen, IPCA. These are names when we invested, they were $1 billion companies or so. Naveen was in fact sub-billion. Actually, I had invested in my prior firm when the company's market cap was $250 million. I had invested a 30 basis point position, 30 basis points. Obviously, in a concentrated portfolio, there's no room for 30 basis points position, right? In a 20 name portfolio, the average position size is 5%. You're not going to invest 30 basis points in a name. So you would have ignored an opportunity like Naveen Fluorine. I used to manage then at that time, 2016, January, somewhere around 2.5 to 3 billion, closer to $3 billion possibly, or $2.5+ billion overall between India strategy and the GEM strategy that I used to manage in India. Yeah. So India component of the GEM strategy. So in a $2.5 billion, you can't invest 5%. So there'll be $125 million. How would you invest $125 million in a $250 million company? 30 basis points is $6 million, if I'm doing the math right. 2 billion, 30 basis points, or 2.5 million, 30 basis, $7.5 million. $6 to $7.5 million you can invest in a $250 million company. That stock is now, from that point, has grown something like 20-fold or something. Yeah, it has paid for the fees all along. 130 basis points position has paid for manager fee, almost all of the manager fee for the next 6-7 years. So a collection of such 30, 40, 50 basis points make up our made up my small cap portfolio there. And even today, I forgot to highlight, but I'll go back to that sheet in a minute and highlight. Our average small cap position is 60 basis points. You can argue what does it contribute, but as you saw in the earlier other slides, small cap and mid caps have delivered very strong alpha to our portfolio. And I can argue that is one of the key reasons possibly we are the best performing team over the last 5 years, because others have this handcuff of not having more than 10, 20, 30 names. We don't have those handcuffs, and hence have been able to tap into opportunities like Coforge, Naveen, IPCA at a time when nobody else was looking at them, because none of the large managers were looking at them because they were too small to be a 3, 4, 5% position in their portfolio. Whereas we took a 1% position, which then multiplied, quadrupled, quintupled, more than double. Obviously, we also have large cap names that have done well for us, like Bajaj Finance, Muthoot Finance with a mid cap name, Abbott India, Torrent, Nestle obviously is a very large cap name. InfoEdge, again, a name which over the last dozen years have made a lot of money, including at my prior firm. And then JB Chemical, again, a small cap name, which we would have bought at 1% or thereabout. So no need to unnecessarily restrict your investment universe. It's suboptimal. Whenever you restrict yourself, it results into suboptimal outcomes. It's like in cricketing analogy, you are fielding in the slips with gully with handcuffs on. It will limit the number of catches that you can attempt and number of catches that you can take. And it's very similar in investing as well. So how many stocks is too many? This is a question, by the way, which I'll show you on the next slide, asked by a very probably the most famous fund manager in his book. So we've asked it here as well. How many stocks is too many? What you see here on the dotted line, right-hand side of the dotted line, is the number of names in our White Oak portfolios, yeah, and the outperformance that we've had on a rolling 3-year basis. And these are the number of names, 62, 58. Yes, it has inched up. Anytime you start a new team, you'll end up having at start lower number of names. That it was same thing was true at Goldman as well. Didn't mean when you have lower names, you have higher alpha or anything. Yeah, like you see here at Goldman, my prior firm. Yeah, this is the data we found from Bloomberg. I had in 2014, 91 names in the portfolio, 2015, 100 names, 2016, 107 names. So call it on average 100 names during these 3 years over there. And the alpha generated, as you can see here, was very robust. 3-year annualized alpha of 9% at the end of 2016, and even stronger rolling alpha over here. And the number of names were always 66, 67 in 2013, which is a terrible year for small and mid cap. When there is very difficult year for small and mid cap, the number of opportunities would reduce. Because again, in 2013 also, yeah, over here, that was the problem. 2013 till mid-year was very difficult. When it's a very difficult year for small and mid, like it was after 18, 19, what happens is the number of stocks that are more than $250 million or more than $500 million or more than $1 billion, they go down. So naturally, the universe shrinks. We can't do anything about it. But at least we should not artificially shrink it by putting handcuffs on ourselves that will only invest in, few number of names. So this graph here, and I've drawn so many things that maybe I should erase a little bit. Sorry, it looks a little messy here, but if you can now look at the graph, yeah. Point is, this is not the first time we have 60 names or more. Yeah, we had 58 names in 2021 as well. I've run portfolios with more than 60 names most time. My average number of names over the prior 10 years would have been possibly 75 or thereabouts. That's had no impact, no negative impact. Even at Goldman over a 10-year period, the performance was top-notch compared to peer group, which obviously I've shared with you earlier, and obviously 5-year performance I just shared is top-notch. So I would say it's not that we had top-notch performance in spite of having large number of names. I think we had top-notch performance, partly, at least partly aided by the flexibility of owning large number of names. We haven't constrained ourselves down with any illogical constraint. Yeah. Now I'm going to talk about a very famous fund manager whom most of you would know, possibly, Peter Lynch. Because everything I've said so far is what I've been saying for the last 16 years, but our team member Dipojal just pointed out to me, fortunately, that in his book, which many of you might have read, and after reading this, I'm quite inclined to read it over the weekend myself. In the book, there is a section which asks the question, how many stocks is too many? And I hope you all know about Peter Lynch. He's the most revered fund manager. It would not be wrong to say he's the most revered fund manager of pretty much all times, or amongst the top 3, top 5, any top list. If it doesn't have a Peter Lynch in that list, it would be not a credible list. Yeah, obviously Warren Buffett is different. He's not managed public money except for the initial few years. I'm talking about fund manager like Fidelity's fund manager. He ran the Magellan Fund, which many of you might have heard of as well. So when Peter Lynch took over that fund, it had about 40 stocks in it. And the performance was, as you can see, with just 40 stocks, the performance over the 5-year period, 70 to 77, was -1% compared to S&P 0%. So it was underperforming by 1%. Yeah. And this is what Peter Lynch says. Fidelity Magellan at 20 assets, there were only 40 stocks in the portfolio, and Ned Johnson, who is the head of, Fidelity was founded by Johnson. I don't know whether by Ned Johnson or his father or whom, but Ned Johnson, Fidelity's head man, recommended that I reduce the number to 25. This is a global myth, not just in India, but globally. And I faced it at Goldman as well, internally as well as externally. People continuously telling me to reduce the number of names. And fortunately, even though I had not read this from Peter Lynch then, fortunately, I ignored them. And this is what Peter Lynch has to say. I listened politely to Ned Johnson. I listened politely and then went out and raised the number to 60 stocks. 6 months later, 200 stocks. And soon after that, 250 stocks. Okay. The point is not to rely on any fixed number of stocks, but rather to investigate how good they are on a case-by-case basis. This is the most revered fund manager saying this. His performance over a 13-year period from 1977 to 1990 was 27% annualized dollar return compared to 15% of S&P. We all know how difficult it is to beat US in the US market. Obviously, it wasn't so difficult back in 70s and 80s, but yet was very difficult. Yeah. So he beat for a 13-year time period by 12%, and which is what makes him a top fund manager in most lists. He has owned on average during his 13-year time period, because he's saying he took it to 150 when he was taking the job. Within a year, soon after, so within 6 months and soon within a year, he took it to 150 stocks. Over his 13-year period, his average number of stocks was 200. With 200 stocks in a market like US, he can generate 12% alpha and be top of the group. Yeah. So anyone who tells you that concentrated portfolio is better, or a focused portfolio or any such small number is better, ask them then, why was Peter Lynch able to be top-notch fund manager, beating everyone else with 1200 basis points of alpha over a 13-year time period? These are just marketing gimmicks. Concentrated portfolio, focused portfolio, these are marketing gimmicks. They sound good, but these have no underlying basis. They've been said so repeatedly over and over again that people have started believing. Those who are saying it also have started believing. They don't think of it as gimmick. It is like superstition. You know, we in India and in many countries around the world, many cultures around the world, if a cat crosses the street, the road, the path, and you walk through it, then it's said that you will have, your work would go wrong. Yeah, if you sneeze in India and then you go, okay, tera kaam bigdega, something wrong would happen. So sit down. Grandparents, parents have always taught that. So even though I've done engineering and I've lived a lot of my life around the world, even though I know this is wrong, but it's been told to me so many hundreds of times while growing up by my grandparents and parents, that even now, if a cat crosses the street in Singapore when I'm walking, I would stop, let someone else cross first, and then I would walk, even though I don't believe in that, because it's been instilled over time, this superstition into our head. Similarly, if you sneeze, I would stop, drink water, and then go out. So similarly, but there's no underlying logic or evidence to these things, right? We all, probably everyone on the call would agree these are superstitions, but they've been drilled into our heads by hearsay for so long that everyone started, and everyone, 100 years ago, 200 years ago, everyone, or even last generation, everyone believed in that. Cat crossing the street or sneezing before going out. And as I'm saying, even now with myself, hard to resist it, because I've been drilled into my head ever since early childhood. So this is nothing, the concentrated few number of names and all that, it's no different from superstition or myth like cat crossing the street. And when anyone next time tells you these, please, I'm going to send this book to anyone who would like to have a copy. So please drop an email to one of our team members, Vivek Sen Gupta, that you like to read more from Peter Lynch, and we'll send this book. It is One Up the Wall Street. It's one of the most famous books, and I'm going to read it, as I said, this weekend, and hopefully would find a few more nuggets like this in the book, and would love to send anyone who's interested a copy of the same as well. So with that, I hope at least the people who are on the call today no longer would believe in this myth about fewer number of names. Just the last thing on that, Grinold and Kahn's fundamental law of active management, not to get too technical, but this is, what is common sense, as I was saying, is also, mentioned here, that the fundamental law of active management states that information ratio, the higher the information ratio, the better it is. That means more skilled you are, grows in proportion to the skill and the breadth of the strategy. Skill is a function of the experience of the team, while breadth is a function of the team's ability to evaluate a large number of names, which is what I was saying earlier. We have built a very well-resourced team to build the ability to evaluate a very large number of names. So information ratio is, the skill multiplied by breadth. Yeah, expected information or skill of the in forecasting returns, and the breadth is the strategy breadth, independent, how many active decisions available per year. Let me go to, so this I already said, the large number of names has helped us deliver top alpha over the 5+ year time period since inception, and the most consistent alpha, the only one of these 12 people listed here to be above average in every single year. You can eyeball it on this slide or on the next slide. I have looked at it fairly thoroughly to make sure that that is indeed true. Okay. Next slide. In the interest of time, this also we've seen over a 3 year, 1 year, 3 year, 5 year. 1 year, by the way, we are already over a trailing 1 year period, the third best strategy. I'm not counting this white one because white one is the index. You can't buy an index. I mean, even index fund or ETF would have costs. So I'm not including any passive manager here, but all the active PMS. So we are already third out of 11 on a trailing 1 year basis. On a 3 year basis, we are fifth out of 11, so above average, and which is not a great thing, but at least most consistent out of this group of top. Just put it differently. Now, one other thing I want to talk about, another myth, another question we've been getting very often. And I'm sorry I've taken up a lot of time, but our team gets so many questions on this that it's better to address this. And maybe if we don't have time, I'm sorry, but maybe we can put the CDMO discussion on the agenda for next time. I'll leave Vivek and Renu you to decide, but I thought this was important to go through in detail, or we can cover in brief the CDMO either way as it's on the agenda. But the other question we have been getting recently is your turnover. Why is your turnover increased so much? Now, here are the facts, okay? The turnover, I don't have the precise number anymore because obviously I don't have access to all the day-to-day data at Goldman. But over the 10-year period, the turnover was over 50% in my recollection and what we could make out from Bloomberg. Turnover by weight, turnover by name was about 30+%. That means the average holding period was a little over 3 years. Because if this was 33.3, then the holding period for a name would be 3 years. Weight turnover includes, besides name turnover, it includes the ads and trims. Yeah. Here at White Oak, the average over the last 5 years has been 48.1%, slightly below the Goldman average. Call it in line with the Goldman average. And the name turnover is 32% over the last 5%, slightly above. Call it right in line because that was also slightly above 30%. Yeah. I was myself surprised when I saw these numbers that they're so consistent. I would have expected somewhat more variance. We don't focus on keeping this consistent. Yeah. The managers out there who focus on keeping the turnover below 5% or 10% or 20%, they've turned turnover into the goal. The goal is to generate performance. Goal is not to keep the turnover low. You'll take suboptimal decisions if your goal becomes low turnover. So if your goal is low turnover or you've committed to clients, I'll keep the turnover low. What happens then? Even if you want to sell a name or two in the portfolio, you'll say, oh, it's only October and I've already crossed 20% in turnover and I've told clients I'll keep 15 to 20% turnover. Maybe I'll wait till January before I sell this name. It's just unnecessary constraint. And you see, yeah, some years, 2018, it was high. So what? We don't focus on that one. What we did then made sense to do. And 2018, as I showed, was the best. We were the best performer amongst that group of 12. Yeah. So high turnover did not stop us from generating the highest performance that year. And other years, it's been, 32, 40, 34. I mean, 22, the turnover was 34. In 20, which was again, we were top of the peer group. Again, our turnover was 48%. We were tops. So this is again another myth. So the number of names in the portfolio was like the cat crossing the street, the path, and this turnover is like, you sneeze, you lose kind of, or you sit down, that kind of a myth. These are different myths. Each manager has their own style. It should be unconstrained of these kind of things. Otherwise, their focus is in the wrong place. Rather than generating alpha, they're focused on these byproducts, if you will. Now, coming to, so I've talked briefly about turnover. If there are questions, I can take more on those. But what importantly I've shown here is it's not any different than history. So you've not all of a sudden changed something. Okay. It's like, we had one bad year last year, and we are very disappointed with that. In 16 years of my career, it is the worst year. It's probably the only year with any material degree of underperformance. 2016 was very slight. But then, we don't want to fix something that is not broken. And this is not broken. Number of names is not the question mark. It's like, sorry to give the analogy, which I've given a few times earlier also. Kohli, when he's playing good, really good, nobody talks about Anushka Sharma. People don't say he's playing good because of Anushka Sharma. But one series he plays poorly, like because of Anushka Sharma, he's playing poorly. Too much distraction. He's become a family man. And then next series he plays well, people forget Anushka Sharma. Yeah. So when we are performing well, nobody talked about turnover. Turnover was in fact higher then. But today people are worried about turnover. So turnovers become like Anushka Sharma. Only comes to people's mind if the performance was weak. Fortunately, it was only weak for last year. Just wanted to leave that at that. Now, what we've done over the last 12 months and has partly contributed to somewhat higher number of names, and there's no negative in it, but I'm just sharing that is, the team has identified quite a few names in the industrial segment, and the weight there has increased. So what this is portfolio composition as of December 2021. And what you see here is portfolio composition 30th April 2023. Obviously, December 2021 is chosen because right after December 2021, we had 6 months of very difficult performance. In fact, the performance was not, the entire 22 was not tough. The last 6 months was more or less zero alpha. Is the first 6 months that had a very big negative alpha. And that was going into those 6 months. If you see, IT services was a very sizable overweight, 8% overweight. Yeah, and what was big underweight was energy, utilities, government-owned companies. We almost had nothing, and all the other things that we talked about in the past periods. Now, these sectors we hardly ever own. Yeah, but we historically, I've tended to own a lot more in industrials, which often acts as a balancing factor to under ownership of deep cyclical kind of companies in India. Yeah, unfortunately, that was low, and that was the mistake which we have since corrected, as industrials have gone from 1% underweight to a 5% overweight during this time. So 6% increase in the weight of industrials, and I'll share some of the names that it includes. On the other hand, we had 8% overweight in IT, that too, a lot of it in mid-cap IT. They've worked really well for us over time. As you saw, Coforge was a top contributor over the last 5 years. But unfortunately, last year, it was very tough for Coforge. Despite the last tough year last year, it is a top performer over the last 5 years. But obviously, it hurt last year. We have reduced the overweight in IT considerably. So almost it is flat with the benchmark right now, even though it has more mid-cap IT than the benchmark. Because we believe these are very high, very strong execution, high on execution companies. So this is one of the major changes. There are other changes also in other sectors internal to the sector as well. But these are amongst the largest changes. 6% swing, if you will, positive on industrials, and 8% So in a way, you can think of money from IT funded the money in the investment in industrials. IT is more exposure to the global capex cycle or global spending. Industrials is exposure to domestic spending. Yeah, and we were very underweight. You can think of it as we were very underweight going into December 2022, start of 2022. We were very underweight domestic cyclicals, and we were overweight global cyclicals. That ended up hurting us. It was not a top-down view that global cyclicals would do well and domestic cyclicals would do poorly. We don't make such top-down views. These are more risks that we tolerate up to a certain limit. And in hindsight, that ended up being too much risk. And we've corrected that at this time. So these are the different names in industrials that we've added at various times, starting with Data Patterns in third quarter of last year, 1st September 22. We've just listed, they could have gone the other way around, but this is to just show that those names have helped stabilize or balance the risk that I was talking about. And obviously this column shows the performance relative to the benchmark of these different industrial names since we've added. So starting with Data Patterns, then this is the initial point of purchase. We might have added subsequently further. We also in third quarter of last year, we added to CG Power. Then fourth quarter, we added Grindwell Norton, Container Corp, and Craftsman Auto, as well as Larsen Toubro. And then earlier this year, we've added in the first quarter, ABB and Hindustan Aeronautics as well. Hindustan Aeronautics in the OFS that they did.